As a reminder, this will be recorded. Great. Thank you all so much for joining us today. For those of you who don't know about the Africa Playbook, it's a series of newsletters, podcasts, and conversations focused on building a blueprint for success in Africa. Odun and I started this initiative because we're both so passionate about Africa's future and wanted to create a space of learning and knowledge transfer for those who feel the same.
And so this month, we reflected on the state of our local capital markets, how far we've come and how long we have to go. So today we'd like to get the perspective of our panel of experts and learn about what it will take for African capital to fund us, African entrepreneurs.
So thank you so much to our panelists who made the time to join us today and to give us a little bit of an overview as we navigate this landscape. I'll let the panelists give a brief introduction on themselves and their respective work. Gerald?
Thanks, and fantastic to speak to you all. My name is Gerald Gunda. I'm an executive for Rescura. Rescura, we are a purpose-driven global investment advisory firm, and we offer what we think are unique insights and guidance to really help and shape the future world that we all want to live in, and primarily advising institutional investors to make the right type of decisions such that when we all retire one day, we exceed our financial goals and we retire in a world we all can be proud to live in.
I'm Mary Njuguna, and I work with FSD Africa as a senior capital market specialist based in Nairobi. But our objective as FSD Africa is to build and to strengthen financial markets in Sub-Saharan Africa. So for me specifically, I work a lot with policymakers, regulators, and market players in strengthening the enabling environment for capital markets in various areas. And part of that work includes a major program that we have, Africa Regulatory Support Program, where we work with about 10 different regulators in different markets on different areas, including product development and regulatory framework development as well. So really happy to be here, and thanks for the invite.
Hi, everyone. So pleased to be here as well. An important discussion topic. Jenny Chamberlain from Alltree Capital. We run a number of Africa funds. Our flagship is our Alltree Africa Fund, a public equity fund that invests in Africa, ex-South Africa. We've been managing that fund since 2006. So we've got quite a lengthy track record. And we have a small credit fund, and we are also looking at launching a women-led impact fund. I have worked on the buy side and prior to that on the sell side at several investment banks in the UK and the US. So have kind of experience of both sides of the aisle in terms of investing in Africa. Looking forward to the conversation. Thank you.
Hi, I'm Joshua Ejakite. I work with a company called Gen Africa Asset Managers. So we're actually the largest pension manager here in Kenya, currently managing around $3 billion worth of mostly pension assets. And I'm a portfolio manager, so my day-to-day job is more or less looking at the investment landscape together with the investment team and figuring out what to put our money in. Definitely a good conversation, one that's been going on for quite some time. Definitely good to continue that here.
Great, thank you all so much. So to start off the conversation, I would love to get everybody's perspective on why capital markets are so important and are so important for African markets. I would love to have Gerald go first and give his perspective, and then would love for each of the panelists to just give a brief perspective on it.
I thought you were kidding about opening up with a difficult question, but I'll give it a bash. Look, I think from our perspective, capital markets, we view them really as a facilitator of enabling people who are deferring the income savings and want to one day retire off those savings, and really channeling or using capital markets as a conduit to then channel those savings, that deferred income, to people who need it to build new companies, to employ more people, to create wealth, and to create a sustainable living environment that we all want to live in. So for us, that's really, if the capital markets are not playing that primary role, then there's something missing within that conversation or that narrative. But ultimately, it's to ensure that capital is channeled from people who don't need it at this point in time to people who do need it, entrepreneurs, so the bulk of the people that we're looking at on the screen, and those entrepreneurs to deploy that capital in a productive and efficient manner to create wealth, to create jobs, and then one day when we all retire, that wealth comes back to us.
That's a great answer. So necessary is I guess, the short form of that answer. Jenny, I would be curious to hear your perspective on that as well, from sort of an opposite perspective as an actual stakeholder in that market. What do you think is the most important thing about capital markets, or why are they necessary for us?
Thank you, Luam. I am very passionate about African capital markets. I think that Gerald is 100% right. They are a very important conduit for people with capital and people who are in need of capital. I also think that they are essential to lowering the cost of capital across the economy. So if you've got a well-functioning capital market, I think that ultimately the cost of capital for the big corporates and all the way down should actually reduce quite significantly. And obviously that engenders further economic growth. So for me, really important aspect. Also, well-functioning capital markets obviously stimulates or facilitates the savings rate for a country. And we've seen in particular throughout this pandemic, savings rates declining across the African continent, which is really unfortunate. And so what I think in Kenya, we've seen the savings rate fall to, I think, below 4%, which is exceptionally low. And so the capital markets should be a conduit for savings for a nation. And then finally, I just think such a young population like we have in Africa, if you look at the actuarial models kind of that have become a standard around the world, young populations should have at least 75% exposure in their pension funds to equities. And I'm interested to hear from Joshua, because that's certainly not the case, I don't think, in most countries on the African continent. So yeah, I guess we are really there and trying to push for greater participation, in particular from the local players, because that's where we need them to participate to generate liquidity, which at this stage has mostly been actually dominated by foreign investors, and foreign investor flows are much more dependent on global economic trends and obviously are at greater risk of capital flight. So for me, it's important to also generate that story within the local African pension market as well as the capital markets. Thanks.
Joshua, I'd be curious to hear your perspective now that Jenny kind of started to touch on your work in your domain.
Yeah, so I think about capital markets a lot in terms of GDP growth. If you're talking about growth in Africa, I believe that the best people to tell you about Africa are Africans. Yeah? If you want to know what's actually going on the ground, it's Africans who are going to do it. So capital markets are key. It's very easy for people to talk about Africa is risky, but if it's going to actually work, if we're going to generate growth, it has to be African capital markets to actually go in and say, you know, people say this is risky, but we don't really think it's risky. And after some time, what used to be risky suddenly isn't risky, just because of that involvement and that back and forth in terms of the capital markets, being able to look at these risks specifically, and the better it works, the better we're able to generate growth and even just create solutions to serve, you know, our citizens. And I think one other thing from the point of view of a fund manager, we are out here actually, you know, most of the time saying no to opportunities rather than saying yes. Of course, capital preservation is sort of a key thing for fund managers. But in the process, we are the ones who, or we are part of the people who are looking at these investments. So the more we develop capital markets, the more we're able to provide our clients with good returns. And as Gerald did say, that they can meet their goals in future.
Right. Mary, before you answer, and I think we've already started to jump into the meat of the conversation, in addition to your answer around why capital markets are essential, I would like to ask, why aren't we seeing like more local IPOs, and what would be the biggest barriers today, in your opinion, that prohibit and disincentivize companies from listing locally? And I have a follow-up to that, but I'd like to hear your thoughts on that first.
Okay, thanks Odun for that question. So on the first one, just my own take and agreeing really with everyone's response. So from a macro level, of course, economies that rely heavily on bank borrowing to fund long-term development, there's a mismatch there, and it's not good for the financial sector. It creates its own strain on the financial sector, which is not good. When we look at, globally, when you look at other markets that have been able to develop to a sustainable level, they've done that on bank borrowing, but there's a point at which it tilts towards capital markets, because you need long-term funding to fund long-term growth. So I think for African markets, when you look at where we are in terms of our own economic growth pathway, it's important that we try to harness this long-term capital through the capital market for infrastructure development and so many other long-term in developments that we have planned. So I think that is very important from a macro level. And I think the other thing I'd say is that many of these long-term projects have social sector outcomes that are very important for the communities in which we live, whether we are talking about healthcare, whether we're talking about housing. These are sometimes the direct link between capital markets and the real sector. Sometimes there's a blurry line, but then it's a very clear linkage. And so capital markets provide that kind of capital, that long-term capital, and especially in local currency. So that it doesn't strain, the economic and fiscal position of the jurisdictions that need it. So that's one. And just to respond to your second question, some of the impediments or challenges in the capital markets. I think that was your question, Odun. So I think for me, the way I look at it, when you look at the capital market as a market, it has so many different points. And in all those, at all those points, there could be an issue, whether you're talking about the market infrastructure. I know liquidity is an issue probably that I've even seen in the comments already coming up. Whether you're talking about the regulatory frameworks, for example, and I can talk about that, that's where I work most in the region. So when you look at the regulatory environment in Africa specifically, most of these capital markets, and for Africa, I think capital markets have been very synonymous to exchanges. These exchanges were created as an offshoot of the privatization, or even part of the privatization program in the 90s in many countries and in subsequent years. So you find that the regulatory frameworks that were developed at that time and that subsist to this day are very tailored to sometimes the large cap kind of companies with heavy reporting requirements. And so some of those, regulatory hurdles make it difficult for SMEs and entrepreneurs to actually consider coming to market, because they'll only associate the exchanges, particularly with some of these larger companies. But it's interesting to see that many markets have developed, many stock exchanges have developed, alternative exchanges to attract SMEs. But I think, whether we're talking about Africa or globally, the reality really is that IPOs in the region have been really far and few between. If you look at 2020, I was looking at the latest PwC report on this, and the statistics are that in 2020, of course, it was a difficult year, there were only 5 IPOs in the region, and that's really, really small. But that is not to say that there's no action in the capital market, because I think the capital market is wider than the stock exchange. So when you look at private capital markets, there's a lot happening in the private equity space, for instance, and a lot of capital is being generated there. So I'll just stop on that particular point. So one, as I said, is I think the regulatory environment. I'll stop there. Thanks.
Thank you, Mary. And still on this question, but I'd like to bring Jenny in a little with the follow-up question, right? Mary mentioned that the liquidity is low, and we've seen like in the comments that there's a liquidity challenge. So do we know what is causing the low liquidity in your opinion? And what kind of interventions have you seen, or do you think are necessary to kind of increase market liquidity and, you know, by extension, increase participation?
Thanks, Odin. So yes, liquidity is low, but I think we've seen low liquidity in stock exchanges like Egypt. And actually with strong economic growth coming out of Egypt, we've seen, I think, almost every single one of those 5 IPOs that Mary mentioned, all in Egypt. And actually we've seen liquidity improve from about $10 million to $50 million average daily traded volume in the last 2 or 3 years. And that's really been following strong economic reform. Whereas Nigeria, we've seen the exact opposite, unfortunately, where you see currency hurdles or a very illiquid currency, and actually a currency that is impossible to repatriate as a foreign investor practically, making it very difficult. So for myself, as a foreign portfolio manager today, I might like the opportunities on the Nigeria Stock Exchange, but I can't actually justify putting my clients' money into that exchange today because I don't know if I'll be able to get their funds out should they request, or should they have a liquidity event, or should we have a liquidity event. And that would probably mean that I might have to get the black market, and the black market trades at a significant discount. And we've seen this same history repeat itself in Nigeria several times over, Egypt as well. Egypt seems to be on a much better, stronger economic track. And as a result, we are seeing local entrepreneurs coming to that market to raise capital, and very successfully, actually. So I think that the African capital markets are ripe for IPOs, but I think a couple of things on that is that often the advisors, if they are big IPOs, for example, Jameer or maybe Airtel or Helios Towers, all use big advisors, JP Morgans, the Standard Banks, who don't actually have Goldman Sachs, who don't actually have local seats on any of the exchanges, and then advise them to look to where there are much larger pools of capital and much larger liquidity. So it's almost a self-fulfilling prophecy in so many ways. And so I also do think that the local pension funds that have adopted almost a buy and hold attitude in terms of their investment mandates don't often trade around their positions. And so that's unfortunate as well. Also because there isn't a wide enough base of companies. So I think the more IPOs, it gives entities a much bigger selection, which then creates the opportunity to create additional liquidity as well. So I think that's really important. Often advisors don't have seats on the local exchanges, so are not incentivized to list companies on the local exchanges as well, which makes it actually very difficult. So we've seen that in one instance actually in Egypt, where a company called Integrated Diagnostic Holdings listed only on London, and actually became very illiquid, and actually now is looking at reverse listing onto the Egyptian Stock Exchange. So that's really one great example of that, where in other cases we've seen something like Zambeef in Zambia, which dual listed in London, and unfortunately with that it sucked pretty much all the liquidity out of the Lusaka Stock Exchange in that name, and also just the general investor attention that people used to give to Lusaka all kind of disappeared at a similar time, or very gradually as less and less interest in the Lusaka Stock Exchange as the liquidity moved in Zambia to the LSE, which was unfortunate. And I think also just with that, you know, we were investors in the LSE, and today we in the Lusaka Stock Exchange, and we actually held Zambeef at one stage. And we moved it to London because that was where the liquidity was. And as a result, we didn't get paid our dividends in Zambian kwacha any longer. So we were looking at, we never had to really look to reinvest or look at other opportunities. And so the Lusaka Stock Exchange became much more secondary to us than when we were looking at other opportunities, because we would have to open a custody account again. And it was just almost a hassle. And I think, unfortunately, investors are really lazy in so many respects. So you need to make it easy for people to come to a market and to facilitate that. And for me, I think that's one of the most important things. And to get the retail investor involved in these markets is so important. But actually, they've been precluded from investing in the African stock markets by so many, almost as an elitism in so many ways, because you've got to find a stockbroker, and then you've got to go through all their KYC, and then of course you can really only invest in that particular market, and the investment opportunities elsewhere or in the region are much more difficult. I would say the EAC have done a much better job than most at that, but those are just some of my insights. I think I've spoken too long. Thank you.
Thank you so much for that perspective, Jenny. I think you touched on a lot of great and useful points that we're probably going to go into a little bit more, specifically as it relates to retail investors and what the regulatory hurdles that make things difficult are. But I do want to take a step back and then talk through that liquidity issue as well. We know one of the big things around liquidity is that big institutional investors like pension funds invest largely in government bonds instead of private or public equity because they get a good yield on government bonds for a relatively low risk. I'm curious to hear from Joshua here with your experience. What do you think would create a sentiment shift, or what do you think needs to sort of happen to be able to move that a little bit more into the direction of contributing more meaningfully to public and private equity markets?
Thanks. Of course, a very good question. I think, just as you've said, Kenya, Uganda, Tanzania, and I'm sure a lot of the other African markets where fixed income is 70 or more % of assets, the reality is what you said. The yield is quite high. And that means, from a fund manager's point of view, if I'm earning 13, 14% from my fixed income portfolio, yes, it's volatile, but not that much. At the end of any year, probably my worst return will be 6, 7%. So that means that I'm incentivized to stay there just because of how high that yield is. I think that to some extent, in my view, I think the level of government borrowing and sort of the level of interest rates is something that sort of has to be addressed. Because the reality is, for many markets in the US, Europe, and other places where rates are lower, then investors have to go out and look for, if you're going to meet your investors or your pension funds goals, you're going to have to go to other assets to actually get that return. But if the return on government bonds is 13, 14%, you could even imagine what bank debt is. So bank debt, of course, has to be sort of higher than that. So I think some part of it is just governments also just looking at, yes, we understand public investment is important, infrastructure and social services are important to invest in, but let's look at sort of the level of rates. Because I think from our fund manager's perspective, if yields were to go from 13 to 6, we'd have to sit around the table and say, okay, how do we look for investments that are going to give us more than the 6 that's on offer? So I think that's something big. I think in some periods, even in Kenya, we've had rates being quite low, and that meant that investors sort of had to go out and look for other investments. But more recently, that's not been the case. So I think that's sort of the perspective. I think that through the journey of especially private equity and venture capital investors or fund managers trying to get into the market, I think it's a journey. So as some fund managers and some pension funds start to invest in private equity and sort of see the returns from it, I'd have to tell you that as a fund manager, it's really powerful if my client has, maybe I share a mandate with 3 managers, then the client tells me, look, the other managers invested in private equity, their returns are 5% higher than yours. That tells me that I need to go do some work and get into those funds or get into that space. So that's also something that I think over time is going to change.
That's completely fair, and that makes a lot of sense. I know, Gerald, we've asked you this question before, but I am curious to hear your perspective from an advisor's lens. Like, what do you think are the biggest things that can change to create that sentiment shift to move people more towards allocating to both public and private equity?
Sure. So I think if you look at Nigeria, it's already happening. Fund managers there for the longest time enjoyed very high yields, and the yields, started to come down, and you've seen for the latter part of 2020 and even now into 2021, them reallocating their portfolios to equities, right? And that's given buoyancy to the Nigerian stock exchange. That and the fact that Jenny can't get her money out, and so she has to reinvest into the market, right? So that's kind of helped. I think also what's helped is really I suppose the investment professionals that are now managing a lot of these pension funds are astute investment professionals. So things like private equity, things like infrastructure debt, things like mezzanine debt are not new concepts. But often you'll find that the regulatory regime that governs pension funds is probably 20 years old and needs to catch up. So you get guys like Joshua that have appetite to start looking at private equity as an asset class, but the regulation needs to catch up to then enable him to now start allocating capital to that asset class. And then lastly, an area that we're involved in extensively is education. It needs to be appreciated that the average trustee across the continent is not a full-time trustee. He probably has a full-time job being a teacher, a doctor, a welder, or whatever else they do. And then once a quarter, they come and have to pay attention to this thing that's called a pension fund. And Joshua is trying to sell this far-flung idea of private equity. It's going to take time to get them to understand that a government bond allocation is not the best allocation for a young pension fund. There's capacity within a young pension fund to start allocating towards other asset classes that will give it capital appreciation and growth and yield over time, possibly to the same level or even better than government bonds. And then I think it's also a double-edged sword in that we've been lulled in the last couple of years by having reasonably low inflation rates in Africa. But when inflation comes back, those government bonds will not yield as much as real terms will not yield as much as you're seeing at the moment. And that's the double-edged sword that the fund managers must often need to play with. So example, you could be a fund manager in Zambia at the moment where inflation is 18, 19, 20% run rate at this point in time. Yes, your treasury bonds are giving you plus 20, 30%, but the real purchasing power of your pension fund is decreasing, right? Because wages are not going at the same rate as inflation, and hopefully it won't be a sustained inflation rate. So it's certainly, there's no one answer to address it, but it's going to involve multiple stakeholders to kind of transition asset allocations traditionally away from government bonds to other asset classes.
Oh, I mean, I
Probably
think
just
that's
to,
very. Oh, okay, sorry, Joshua. Please go
sorry,
ahead.
yeah, I just wanted to give a bit of perspective to what Gerald is saying, because there's some things that, for example, in Kenya, we have pension schemes that are quote unquote segregated. So, for example, each SME, each company has its own sort of pension scheme. And what that means is that when we go, for example, to pitch private equity or venture capital, when we pitch it and we say, look, we want to allocate 5% to your portfolio, first of all, we can't do it on a discretionary basis. So we have to actually go and talk about the specific opportunity. Then after that, the client asks, okay, this SME we could have problems, we could have layoffs. How do we get out, down the line? And we're talking about private equity and venture capital. These are investments that we should stay in for the long term. So it becomes a problem. So ideally, like for us, if these investments were sort of pooled, if there's a provision for a lot of pooling of these investments, liquidity doesn't become an issue, because if it's just one pension scheme that's 1% of the pool or 5% of the pool, you can comfortably allocate to private equity and venture capital, knowing that the whole pool won't face any liquidity challenges. But because they're sort of very small funds, it becomes challenging.
I couldn't agree more. That was a really, really good point. And I'm going to ask Mary this next. On the back of every conversation that we've been having, I'd like to know how you are thinking about market fragmentation and economies of scale. And here's a question that I'd like to hear from Mary and I think Jenny. Should we be focused on creating as many regional exchanges as we can, or should we be trying to like create a Pan-African exchange, or both?
Okay, thanks Odun for that. So my view on that is, I think right now as we speak, even the linkage program, there is an African exchanges linkage program that is ongoing, funded by the World Bank. So I believe that kind of initiative, using the various linkage opportunities through digital technology that we have in place, that should be able to really make it easier for investors to access pools of different kind of investment opportunities in different markets. But even aside from that, I think even this Africa, the free trade area scenario presents an opportunity, because when you look at it from aside from the trading part of things, because I think even when we look at the platform there, when we look at the market, there is the platform for trading, but also who will be bringing their company or listing their securities on that platform. And that particular Africa, efforts on trade will actually, I think, present an opportunity for SMEs operating across different jurisdictions to also rely on those platforms that will be developed. I don't know whether, I know that, creating a regional or Pan-African exchange is, these are some of those things that really are heavy in terms of infrastructure, and therefore maybe the best thing is to leverage on what already exists to the extent that it can be interlinked. And that's why I'm talking about this African Exchanges Linkage Program, or even the EAC program. But even beyond that, I think there is more than that, where, for example, like in the East African region, the regulators within the East African region there's a regulatory framework that allows an issuer to issue a product in one market, and it can be issued across the board within that region. So aside from the market infrastructure, there's also the regulatory framework that should allow issuers to actually be able to operate across borders to the extent possible. So I think I would say that yes, there's an opportunity for the interlinkages within exchanges, but also beyond that, the actual framework that allows them to that allows issuers and investors to actually operate across borders. And I think that would be important where we are going as a continent.
I see Gerald has his hand up, so I would hear from Jenny first, and then Gerald, you go.
Thanks, Gerald. Ladies first. So just, I think my view on that is, obviously, stock exchanges are a source of national pride, I think, for all of these countries. We have seen the EAC countries with a lot of dual listings. From an international investor's perspective, I incur custody charges, as I've said, and these are one of the, I think, the barriers to entry are some of these trading costs, which is another bugbear of mine. But every market that I open in, I incur another custody fee. And the minimums are fairly high, even for Africa. And so I think from an international perspective, it's easier just to trade on one exchange, absolutely. But I actually think for the growth of the local economies, it's so important, because if you look at the cross-listing, for example, of Bank of Kigali in Rwanda, today, all the trading of Bank of Kigali practically is on the Nairobi Stock Exchange. And as a result, it's actually sucked all the liquidity out of the Rwanda Stock Exchange, which I think is really unfortunate, because it then takes investors' attention from that local exchange to the Nairobi Stock Exchange. And so I think that it is important for these local stock exchanges. And I think what I like about the African Exchange Linkages Program is that actually it links the brokers, and so gives people an opportunity to buy a South African to buy MTN Nigeria, or Bank of Kigali, but you're still having to facilitate that trade via the local exchange on the local exchange. So you're still cultivating that local exchange. And I think that if you're wanting to get local retail investors involved, ultimately you need to have that joint effort on the local exchanges as well, because I think people intuitively are more comfortable initially with those initial investments. So to start engaging at the retail investor, which, as Gerald pointed out, is a huge education process as well. But in order to start engaging them, you need to engage them with something that they're familiar with. MTN Rwanda, I know that company. That's they're my mobile phone operator. I can understand who they are. So in order to create liquidity, we also have to incorporate retail strategies. And I think that if you create a huge, big Pan-African exchange, I think we're at risk of losing some of the retail investor base, or it'll take much longer to cultivate. Gerald, over to you.
Sure, thanks. Definitely concur. And I just also wanted to add the point that I think, at least with the research that we've done under the auspices of FSD, where Mary and I think one of her colleagues, Brian, is on the line, is also the reality that in a lot of these African markets, you have very big anchor institutional investors, social security funds. And often if you are contemplating an IPO, if that big anchor investor or group of anchor investors do not underwrite your IPO, it's destined to failure. So, and the problem is that, if one big institution underwrites and the other one doesn't, all the other institutions in the market also lose confidence. So they want to see all big institutions underwriting in order to participate. And if none of them do, then no one underwrites, which is, a circular reference. Then the other consideration that we've seen in our research is obviously the fact that the regulations are changing, but often you'll find that it's written that if you want to IPO, you must have X amount of track record of profitability, X amount of turnover, et cetera, et cetera. And some SMEs just won't meet that criteria. And then, we sat in yesterday on an IPO of a pension provider in the UK called Pension B, and it's got no profit and has not made profits in the last 3 years, but it IPO'd successfully, fully subscribed, and I think it's around 16 to 17% of that was actually underwritten by retail investors through an app called Primary Bid that actually allows for retail investors to participate in IPOs. So I think practical advice is to really also look at the market structure and to say, how are we then going to incentivize larger asset owners to underwrite smaller IPOs in different exchange settings? And you're starting to see small to medium-sized exchanges being established across a number of African countries, but those also need support from large institutional investors, which means you need to change the mandates as well.
Just to touch on.
Sorry.
Yeah, sorry. Wanted to add to Gerald. I just wanted to say, there's a bit of an issue there, I would say, because sometimes, for fund managers, and you have, let's say, 50 mandates or so for pension clients, there is sort of convention that you treat your clients the same. Okay, the same clients, the clients who pay the same fees get treated the same way. So if the issue is too small, it becomes sort of difficult for you to get all your clients in, depending on how big you are. But these are sort of issues that would have to get through. I think part of the solution is to sort of build these other pools of capital, retail investors, high net worth investors, where for those investors, given that the mandates may not be as many, and especially if it's a fund, then it's just easy to have them exposed to that IPO as opposed to having it segregated or having many of them.
So yeah, I think Gerald made a very interesting point about retail and on management as it relates to retail investors. So we've seen a strong growth in the adoption of wealth management apps on the African continent that allow Africans specifically to invest in US securities, right? We have Bamboo, we have RiceVerse, we have Chaka, several of them that are currently running businesses. How do you think that we can then proceed to re-engage retail investors to participate in local exchanges?
Is that for me?
Gerald, sorry.
Okay, sure.
Yeah, it's for you.
So, yeah, like it or not, and some may find this controversial. The same way you see, I don't know, Airtel or MTN or any other consumer-facing business advertising heavily, is actually the same way you actually need to treat the retail investor, because you're fighting for attention from, and it's not just the attention, you're actually fighting for focus of their pocket. And you then need to, once you've got their attention, you then need to now educate them on the thematic of investment. And, particularly for us as professionals that are looking at retirement savings, if you go to the average person on the street in Zambia and say, invest in Zambeef because you go and shop at a Zambeef store and that's where you get your poultry and beef products, that may be a better value proposition to say, put this money aside for the next 40 years and it'll compounding interest will look after it, and then you'll be able to retire it. There needs to be some sort of affinity and relation to savings as an endeavor that is very much aligned to consumption and attention focus. And I may be describing it badly, but ultimately, and you would know better, Adonai, that the fight for attention of the retail consumer is actually where it's won and lost. And if you bore them, if you can't capture them long enough, and if it's not easy for them to use the application, you're never actually going to onboard them onto using that savings vehicle. So it nearly needs to be, we need to change it and actually make it fun, sexy, exciting to save. It needs to be compelling in the same way as other things that are competing for their attention. And if you're not packaging it that way, you actually are never going to capture that savings pocket.
Yeah.
Yeah, I agree 100% with Gerald. Can I add, Odin? Sorry. But you also need to have the returns to match that. So we've seen this in Egypt, where actually the Egyptian stock exchange is now doing well. So we've seen the retail investor come back. So we need to, obviously with yields collapsing in Nigeria, we've seen the retail investor come back as well, which has been so exciting to see. But we haven't seen that really in the East African region, where I think there's still some scars left over from the Safaricom IPO all that time ago in 2008, where the price literally halved. And that IPO was actually a phenomenal opportunity to actually attract the retail investor into the Nairobi Stock Exchange. And so I think people will invest if they can see the return. And that's why people are investing abroad, because they can see the return. So they need to, but obviously liquidity begets liquidity. So you need to have something, and Gerald's 100% right. One, we need to get the retail in, but we need to make it exciting so that they can see the returns from that as well, which is something to look out for. And make it easy, the laziness factor.
I see Joshua and Mary have their hands up as well, but I would love to add a layer to this conversation that was asked by Peter. So how do you think about the pay for order flow within the context of African capital markets? Do you see a future in which exchanges essentially pay wealth tech startups focused on retail investors like Bamboo and the ones that Odin mentioned, and maybe Piggyvest in the future, for bringing much needed volume and liquidity to the market? Do you think there's an opportunity to do that? But I'll let maybe Mary go first, and then Joshua.
Thanks. Thanks for that. Well, I think there's an opportunity to see how to mobilize some of these savings in a more I think we need to rethink, for example, how we mobilize retail investment through the capital market, stock exchange, because I think even how we rethink, when I look at the data on growth of, for example, the mutual fund collective investment schemes across several markets, like I was looking at Kenya and Nigeria, much as they have not, in those markets, there have been few IPOs, if any. When you look at the growth of the collective investment schemes or mutual funds, they've been growing steadily over time. So I'm just thinking probably one of the things to consider, even picking on what Joshua has mentioned on how some of the pension funds can be facilitated to invest through a fund structure. I think one of the things that we seek to do is to work closely with pension fund regulators, fund managers themselves, and also on the retail side, just to consider innovative fund structures that can be used to actually pool capital. And so even, using also digital tools that can be used to actually deploy more capital in that way. Because I think as these funds grow, I know right now when we talk about institutional investors, we are looking a lot at the pension fund industry. But if you look at the data, the collective investment schemes have been growing. And so if they can continue to grow innovatively, then there's another additional pool of capital in that whole pot, which can be steered towards products on the market.
Joshua?
Yeah, I just wanted to say that I think there's a huge opportunity for especially like fund managers in Africa to actually pay attention to customers. So the way I look at it, the models, especially in East Africa, really look at the cost as is of getting a customer on board. So there isn't that much innovation in trying to make the process easy. I think someone in the comments mentioned that they have an app, they can buy Bitcoin, they can buy Tesla from, and they're here in Africa, but they can't buy, a fund, a mutual fund here in Kenya or somewhere else. So I think there's a big opportunity there to sort of just look at that value chain and say, from how much education first is there, and does that customer have access? Because in Kenya, we have mobile money. Mobile money is big in Kenya. Somebody can get their money from their bank into their phone, into an investment or direct to an investment, pretty easily. So that part of the chain is sort of sorted out. But I think it's part of the KYC and some of the other processes. And I think possibly not too much attention has been paid to that. I think there's a big opportunity there for innovation and quote unquote disruption, just to get people on board. I think just to talk about some of what Mary has said, unfortunately, even though sort of collective investment schemes have grown in Kenya, a large portion of that is money market funds. So money market funds is just deposits and treasury bills and the like. So yes, we would need them to grow, but we would of course want them to grow on the equity side and other products. And I think education is a big part of that, and just getting retail investors to get involved in the investor journey. I think some of other things that I just have thoughts about, just about how these products are distributed. I don't think customers really feel close to the products and feel that these products serve them. So I think there's space there to educate and just get investors to, because you'll be surprised when it comes to pension funds, because actually a lot of Kenyans who are employed have pension funds. When I go to make my presentation on how the year was, I get a lot of questions. I get, why did this stock go down? Why didn't you invest in this? Why did you invest in this? So there's a lot of engagement there, but there isn't engagement on the sort of the 90% of the rest of the income that they're looking to invest. So I think there's opportunity there to sort of encourage engagement.
Right. So we just have about 10 minutes left, and we promised to incorporate Q&A. So I'm just going to ask some questions from the chat. Right. Gerald and Jenny, I'm asking this to both of you. So Gerald, go first, and then Jenny. Of the top 30 East African companies, including Mauritius, more than 50% trade at price to book values of 1 or less. Why aren't the local institutions actively buying value equities? There will be no IPOs unless equity valuations are fair. Are equity valuations fair at present?
Yeah, look, I mean, Jenny touched on the point that a lot of pension funds really are buy and hold. So that kind of depresses any liquidity or activity that goes around the numerator side of things. So the price doesn't actually move because no one's bidding. And then secondly, I think in terms of the proposition, the earnings yield that you're getting from a lot of these companies compared to fixed income yields, government bonds, pales in comparison, right? From the broader market. If you're taking the earnings yield from maybe your top 3 or top 5 shares that are most liquid versus the long tail that you have in most African markets of your smaller cap shares, and then compare that to what you can get from a government bond that you can sell within a day, the value proposition for equity then becomes a lot less compelling. So unfortunately, that's the reality that you face in most of these African markets. Jenny, I'll hand over to you.
So I think the valuations on these African capital markets are extremely compelling. I, in my lengthy career of looking at them, haven't seen them quite so attractive in quite some time. I think there are a number of reasons for that. One, obviously, there's a lot of the flows in these African capital markets are dominated by foreign investors. Today, still, despite outflows on the Nairobi Stock Exchange, foreigners still account for about 70% of the average turnover. And so as a result, we've seen more selling than buying. And so, yes, I think the valuations are really cheap. We own, and just on the yield side even, yes, it's an annual yield when the company just decides to pay dividends. And some of these have become a little bit more at risk because of the pandemic. But especially from the banking sector, where central banks have stepped in and said their banks can't pay dividends at the moment in certain countries. But if you're looking at even from a dividend yield, I mean, we just received a dividend from a company in Botswana on a 12% yield. So I think that the yields are there. I think the valuations are compelling. I think that the issue is, though, we've seen as foreign investors have been dominant in a lot of these markets, their flows are predicated on different investment criteria. So they are predicated on looking at global risk. And I think there has been a general concern. In fact, we've seen, unfortunately, in Africa, numerous Africa funds actually closed last year in 2020, and some are still closing this year as they're liquidating. And that's really unfortunate. And so with that, you see more selling pressure, and as a result, valuations are cheaper. But it also, you find that the local guys are very aware of what's going on and are really trying to bottom pick. So they'll wait until the very end to come back in and pick up some of those bargains. And we've seen that in the Dar es Salaam Stock Exchange, for example, where there was a very big overhang in National Microfinance Bank, and that stock became so illiquid for a long time. And I think the other issue is that is on some of the trading requirements and rules and regulations set up by some of the stock exchanges, like the tick size, which I think is crazy. I think that the minimum size to change the share price is another crazy regulation. So there's lots of regulations that need to change to be able to, so people can pick up those bargains and liquidity will come back in. So yes, I think that they are trading at crazy prices. I think the concern just goes back again to the government bond issue. We've seen Nigeria, as yields literally collapsed in Nigeria, we saw the market come back. It was up 47% in dollars last year, despite its devaluation. So there is that opportunity, but people are looking to make real returns. And so I think that comes back to Joshua's statement at the really beginning of the call, where he said the thing is that his worst year ever was 6 or 7%. And actually at the moment, he's getting a much better yield of government treasuries. So the risk reward factor from investing in equities to government bonds is still a major, I think, prohibitor, unfortunately.
Absolutely. Yeah, thank you so much for that. And I do think there's a lot of pieces there as well, especially as it relates to currency risk, because I know that's another issue when you're looking at multiple countries, different exchanges in different currencies. But I'm curious because we only have 3 minutes left. Unfortunately, I think this panel was great. But I'm curious in kind of a wrap-up thought, like what sort of intervention or progress gives you hope in this next iteration of growth that we will hopefully see in our local capital markets? I'd love if each of you could take about a minute and just tell us like what intervention is it that is currently in process are you most excited about, or what prospective intervention are you most excited about? I know that's a tough question. So I'm gonna pick on Gerald, because we've just picked on you so much this month.
Yeah.
I'll pick on you to start.
Yeah, look, I mean, we not only look at public equities, we look at private capital investments as well. And, you know, just in the last 2 years, the number of seed stage funds, VC funds, impact funds that are popping up and increasing within the ecosystem is great. Because before, the problem was that, you know, at least for us as advisors to pension fund, it's not good enough for you to only show one PE fund or one VC fund. You need to show a collection and demonstrate that you've chosen the best of a collection. So as you get more capital flowing into that space, more funds, more managers, you really get good diversity and in terms of sectoral focus, in terms of product focus, in terms of regional focus. So, and that we believe is then going to be a very good throughput into the public capital markets, both debt and equity, in the fullness of time.
I'm happy to follow on from Gerald.
Thanks, Jen.
So I think from my perspective, I think what's exciting is some of the disruptors that we're seeing to the traditional stockbrokers, like PE Invest. I think fantastic. We need to see more of those. I think we need to see stronger encouragement of local retail investors. I think with the global movement that we're seeing with the likes of primary bid, the retail investors are really flexing their muscles. And so I think they're a category of investor that cannot be ignored and shouldn't be ignored. And I think from crowdfunding to, to these disruptive technologies that we're seeing through apps and that kind of new technology, I think is so important. And I think they are going to be a really growing importance to the development of these exchanges. So I'm excited. I really am. I think that I feel that there's a wind of change, and I am looking forward to being part of that journey.
I think I'll jump in there. Actually, Jenny took my point on digitization and just using innovative ways to reach clients. I think there are many opportunities on that front from many levels. But I think in addition to that, as we move closer to, a lot more digitization, connectivity between markets or between investors and funds, whether it's funds or issuers or, the whole ecosystem. I think then there'll be a real change in the how can I call it, in the playing field, in terms of just making sure that investors understand better what different products are all about. I think there'll be a real push or drive for that. And I think we just need to go there as capital markets, because I think as I saw in the charts, probably the fact that many people are investing in, retail investors are investing in money market funds means that there is capital to invest. Probably that's just the safest instrument that they want to pursue, or the one that they understand best. So I think there's a lot to leverage on in terms of just capacity even with transaction teams, with pension fund trustees. I think there's capacity across the board, and there's a lot that can be leveraged in addition to the initiatives that have been mentioned as well. Thanks.
Yeah, I think I would say, especially from our perspective as sort of institutional investors, I think trying to break down some of the regulatory challenges, or basically to make it easier to pull funds and then now start to allocate in a much more forward-looking way. I think that's something that's exciting, because I think some part of the investor journey is trust. So if you have a relationship with a fund manager and they've been delivering returns for you, if they tell you that they're going to allocate to something else, that trust continues, and through that we're able to allocate to more asset classes and basically get the retail investor involved. So I'm excited about that. I think digitization, as everyone else has said, is important, because it actually helps that value chain to make it so that it's much easier.
And I'm hoping, sorry, just to add one last thing to this conversation, is that with stronger volume, with better volumes, and more activity, we also see lower costs, because the cost of trading in these markets, the bid-offer spreads, often through regulatory reasons, are really wide. And so that obviously reduces the return for an investor. So that's another area that I think all the exchanges need to look at across the continent.
I mean,
and FX trading costs as well, but that's more of a foreign investor issue. But an issue as well for Pan-African investors when you're looking at investing from Kenya to Tanzania, or Kenya to Nigeria, or Kenya to Egypt. It's another really important thing is that the cost of I actually often get really mad because I pay more on the bid and offer spread on my currency than I do to the broker. And actually my custodian's not doing very much for me.
All right. Well, I just wanted to say thank you to everyone. And as a fintech player, I'm obviously very excited about the rise of retail investors, and I'm kind of very bullish on what retail fintech companies, especially ones that are exposing individuals to securities, are going to achieve over the next 5-10 years. But again, I wanted to say thank you to each and every one of you, Gerald, Joshua, Mary, and Jenny, for joining us in this informative session. And thank you to everyone who attended as well. Loam and I are trying to do this monthly, this kind of knowledge sharing session. So please follow us at Africa_Playbook on Twitter. And we have our Spotify, we have our website, we have our LinkedIn, and that's where we share information about our next events and our next posts. So this has been an incredible focus on the African capital market, and we hope that there is going to be more excellent conversations that come out of this.
Yeah, I just want to reiterate what
Loam, did you want to add
said.
anything?
Yeah, absolutely. I just want to reiterate what you said. Thank you all so much for the time that you've given us today, especially I know it's a little bit late on most of your sides after the workday, so we really appreciate you making the time to sit here with us and to really share a lot of your knowledge and to hopefully transfer that to a lot of our attendees today and all our subscribers of the newsletter. As I did mention, we're looking to do these monthly, so definitely follow us, and we look forward to hosting more in the future. Thank you all so much.
And thanks to you for setting this up.
Thank you.
Really
Have a
fun
good day.
opportunity.
Bye.
Thank you.
Thank
Bye.
you. Bye.